Hi, this is Steve Bray with today's Star Bits. I saw a piece on a news site the other day interviewing a national lender offering sub 2% rates on 30-year fixed mortgages. It sounds incredible, and I'm sure it's made the phone ring from homeowners wanting to take advantage of this once-in-a-lifetime opportunity. Remember as a kid when you learned when things seem too good to be true? Well, let's take a closer look at this loan program to understand how it works. Full disclosure, as a broker, I have a relationship with this lender and offer this program. To understand how the program works, you need to understand a little about mortgage rate pricing. Mortgages are packaged as investments, and investors are willing to pay more for a mortgage with a higher interest rate because it produces a greater income stream. Mortgage companies like ours know how much money we need to make on a loan to remain profitable. If the investor pays us more than we need, we give the excess to the customer as a credit against closing costs. If the investor pays too little, the customer makes up the difference in the form of a discount fee, also called points. Let's say that investors are willing to pay just the right amount for a mortgage with a 3% rate. That means every mortgage with a lower rate will require a discount fee. Today, that 1.999% rate required 3.5 points, or 3.5% of the loan amount, as an additional closing cost. Now, just because a rate requires points doesn't make it a bad deal. You have to do the math. A simple way to estimate whether paying points makes sense is to divide the discount fee you have to pay by the amount the rate lowers your payment. Let's do an example with a $300,000 loan. The principal and interest payment for a 3% rate is $1,265. The payment for a 1.999% rate is $1,109, a savings of $156 a month. To get that lower rate, you would pay 3.5 points, or $10,500. We divide the fee by the savings and get 67. This is roughly the number of months it would take for the savings from the monthly payments to equal the points you had to pay to get the lower rate. If you plan to keep the mortgage longer than 67 months, you'll save more money with the lower rate. Now, the calculation ignores some secondary factors like the time value of money and potential income tax savings, but it's a good rule of thumb for deciding when paying points makes sense. That's Star Bits for today. Please follow us weekly on social media and on our Texas Lone Star Lending website.